Ladies and gentlemen, let me begin with a simple but powerful question. Why would the world's most powerful government rush to spend billions of dollars securing one single metal? This is not a coincidence. This is not routine budgeting. This is a signal. When the US government allocates $7.4 billion to secure silver, it tells us one thing loud and clear. They see something coming, and they are preparing before the public realizes what is happening. History teaches us that governments act early, quietly, and decisively, while the masses react late, emotionally, and expensively. When a government commits billions of dollars towards securing a single commodity, it is never a casual decision, and it is rarely reactive. Such spending reflects long-range economic forecasting, national risk assessment, and strategic preparation based on information that is not yet fully visible to public markets. Governments operate with access to supply chain, intelligence, defense requirements, industrial demand projections, and geopolitical risk models that private participants rarely see in real time. So when the US government directs $7.4 billion towards securing silver, it is not responding to today's prices, headlines, or speculation. It is positioning for conditions it expects to emerge tomorrow. The real hook here is this: markets move after governments prepare, not before. Historically, large-scale government intervention in commodity markets has preceded periods of disruption, whether through war, technological shifts, or monetary instability. Strategic stockpiling has always been a silent warning system. Governments do not stockpile assets that are abundant and easily replaceable. They secure assets that are becoming constrained, critical, or strategically irreplaceable. Silver fits this profile perfectly. Its role across defense systems, energy infrastructure, medical technology, and advanced electronics makes uninterrupted access essential for economic stability and national security. When continuity becomes uncertain, price becomes irrelevant, and availability becomes the priority. Another overlooked signal is timing. Governments tend to act before scarcity becomes obvious because once markets recognize shortages, acquisition becomes exponentially more expensive by entering early. They reduce exposure to future price shocks while limiting open market supply. This alone can create a feedback loop where institutional accumulation tightens availability for the broader market, increasing volatility and reinforcing the original concern. The hook most people miss is that government spending does not merely respond to scarcity, it can accelerate it. This behavior also reflects a broader shift in economic strategy. In an era of rising debt, persistent inflation, and fragile supply chains, reliance on just-in-time markets has proven risky. Governments are increasingly prioritizing resilience over efficiency. That means securing real assets that cannot be digitally created, politically negotiated, or rapidly substituted. Silver's physical nature makes it immune to monetary policy manipulation, and that characteristic alone elevates its strategic value during periods of financial stress. For individuals and investors, the lesson is not to panic, but to interpret signals correctly. Economic transitions are rarely announced. They are revealed through actions. Budget allocations, procurement strategies, and resource accumulation speak louder than public reassurances. When a government chooses preparation over complacency, it signals that the cost of being early is far lower than the cost of being unprepared. Those who understand this dynamic do not wait for confirmation from headlines or price charts. They study behavior, incentives, and historical patterns. Because in economics, the smartest moves are often made quietly, long before the crowd realizes why they matter. The critical hook is that these two demand forces do not cancel each other out, they reinforce one another. This interaction creates a structural imbalance. Industrial users cannot simply pause demand without disrupting production, while monetary demand tends to surge suddenly, not gradually, when both rise together. Pricing becomes less about equilibrium and more about availability. Even small shifts in investment demand can overwhelm supply that is already being steadily consumed by industry. This is why silver markets are particularly sensitive to macroeconomic shifts. They operate on thinner margins than many investors realize. What makes this dynamic especially powerful is its asymmetry. Industrial demand is relatively price insensitive because silver often represents a small fraction of total product cost, while monetary demand is highly responsive to systemic risk. This means higher prices do little to suppress usage, but rising uncertainty can rapidly accelerate accumulation. In economic terms, this is a setup where demand expands faster than supply can adapt. Those who understand this dual role recognize that silver's value is not driven by narrative, but by necessity, a necessity that intensifies in times of transformation. Silver's market dynamics are heavily shaped by the reality that its supply cannot respond quickly to rising demand, no matter how strong price signals become. In economic terms, silver exhibits pronounced supply inelasticity, meaning production cannot be expanded rapidly even when higher prices would normally incentivize increased output. Mining is a capital-intensive, time-consuming process that operates on long planning cycles. From exploration and permitting to financing and construction, new silver supply often requires a decade or more to reach the market. The hook many overlook is this: by the time higher prices appear to signal opportunity, the window to respond has already closed. This rigidity is intensified by the structure of silver production itself. A significant portion of global silver supply is not mined as a primary metal, but as a byproduct of copper, lead, and zinc extraction. This means silver output is often dictated by the economics of other metals rather than by silver demand alone. Even if silver prices rise sharply, producers cannot simply flip a switch and increase supply unless base metal markets justify expanded production. This disconnect weakens the traditional self-correcting mechanism markets rely on and creates conditions where shortages can persist far longer than expected. Declining ore grades further constrain responsiveness. Many of the world's largest silver deposits have already been exploited, forcing miners to process more material to extract the same amount of metal. This increases costs, energy usage, and environmental impact, all while tightening regulatory scrutiny. The result is that higher prices do not translate into proportionally higher output. Instead, they often reflect rising production challenges. The hook here is that scarcity is no longer theoretical, it is operational. Regulatory and geopolitical factors compound this inelasticity. Mining approvals face increasing environmental, social, and political resistance, particularly in jurisdictions with rich mineral reserves. Governments may impose export controls, higher royalties, or nationalization risks that further discourage rapid investment. At the same time, global supply chains remain fragile, making equipment, labor, and financing less predictable. These frictions slow expansion even during favorable market conditions, turning supply constraints into a structural feature rather than a temporary imbalance. For markets, this creates a critical vulnerability. When demand accelerates, whether from industrial expansion, strategic stockpiling, or investment flows, supply cannot rise in parallel to stabilize prices. Instead, adjustment occurs to volatility and rationing, not production growth. The key hook is that inelastic supply transforms demand shocks into price shocks. Those who understand this dynamic recognize that silver's market is not designed for smooth corrections. It is designed, by its very nature, to amplify imbalance. Persistent inflation and expanding sovereign debt levels are not abstract macroeconomic concepts. They directly reshape institutional behavior and capital allocation decisions. When governments run sustained deficits and central banks respond with accommodative monetary policies, the purchasing power of fiat currencies gradually erodes. Institutions understand this dynamic far better than the public. Because they operate on long-duration liabilities and balance sheets that cannot afford silent appreciation, the hook many miss is this: inflation does not destroy wealth loudly. It does so quietly, and institutions hedge long before the damage becomes obvious. As debt accumulates, confidence in future fiscal discipline weakens. Servicing large debt loads increasingly depends on continued currency expansion, financial repression, or lower real interest rates. This creates a structural incentive to hold assets that exist outside the credit system. Institutions and governments respond not with panic, but with calculated hedging strategies designed to preserve real value, rather than nominal returns. Silver, as a tangible asset with no counterparty risk, becomes attractive precisely because it cannot be created, restructured, or defaulted on through policy decisions. Inflation also distorts traditional portfolio construction. Fixed income instruments, once considered safe, struggle to deliver positive real returns in inflationary environments. Even equities, while offering growth potential, remain exposed to valuation, compression, margin pressure, and systemic shocks. This pushes institutional capital toward diversification into real assets that behave differently under monetary stress. The hook here is that silver is not chosen for performance chasing, it is chosen for resilience. Another critical factor is trust. Modern financial systems rely heavily on confidence in currencies, institutions, and policy frameworks. When inflation persists longer than expected, that trust begins to fray. Institutions do not wait for a crisis of confidence to become public. They respond to early signals, adjusting exposure quietly and methodically. Allocating capital to silver functions as an insurance policy against policy, error, geopolitical escalation, or currency instability. It is a hedge not just against inflation, but against uncertainty itself. What intensifies this trend is synchronization. Inflation and debt challenges are not confined to a single economy, they are global. When multiple governments face similar pressures, competition for real assets increases. This collective hedging behavior amplifies demand without requiring speculative enthusiasm. The hook is subtle but powerful. Silver demand rises not because everyone agrees on the future, but because no one is certain enough to ignore risk. In this environment, institutional moves reflect survival economics rather than opportunity seeking. Preserving purchasing power becomes a strategic objective, not a tactical trade. Those who understand the shift recognize that when institutions hedge, they are revealing vulnerability within the system. And when vulnerability rises, assets that exist beyond policy reach move from optional to essential. But in an increasingly fragmented global economy, control over critical resources is no longer viewed purely through a commercial lens. It has become a core component of national power and strategic resilience. As geopolitical competition intensifies, nations are reassessing which materials are essential for economic stability, technological leadership, and defense readiness. The hook many underestimate is this. In the modern world, economic strength is no longer defined only by capital or currency, but by access to what cannot be easily replaced. Silver sits firmly within this category of strategic materials. Its role across defense systems, secure communications, advanced weapons, platforms, energy infrastructure, and high-performance electronics makes uninterrupted supply a national priority. When access to such a resource is uncertain, dependency becomes a vulnerability. Governments understand that relying on global markets during periods of tension or conflict exposes them to supply disruptions, price shocks, and geopolitical leverage exerted by others. Securing physical supply in advance reduces exposure to these risks and shifts bargaining power back to the state. What makes resource control particularly powerful is its asymmetric nature. A country with secure access can maintain production, innovation, and military capability, while those without it face delays, higher costs, and strategic disadvantage. This imbalance does not require conflict to be effective. It operates quietly through market pressure and availability. Constraints. The hook here is that control over resources shapes outcomes long before any visible confrontation occurs. Global supply chains, once optimized for efficiency, have proven fragile under stress. Trade restrictions, sanctions, logistical disruptions, and regional instability have exposed how quickly access to essential materials can be compromised. In response, governments are prioritizing redundancy, stockpiling, and domestic sourcing where possible. Concentration in specific mining regions and its dependence on silvers on byproduct production make it particularly susceptible to these disruptions, reinforcing its strategic value. This shift also reflects a broader redefinition of national security. Economic continuity, technological sovereignty, and industrial capacity are now treated as defense issues rather than purely market concerns. Resource control underpins all three. The hook many fail to recognize is that when governments secure materials like silver, they are not reacting to markets, they are insulating themselves from them. As competition for critical resources intensifies, those with foresight gain leverage. Control ensures stability during crisis, bargaining power during negotiation, and continuity during disruption. This is not about hoarding. It is about ensuring that national systems function regardless of external pressures. In economic terms, access to silver becomes a competitive advantage that compounds over time, reinforcing resilience while exposing the fragility of those who depend on open markets that may not always remain open. Economic history repeatedly demonstrates that markets do not reward those who react fastest to headlines, but those who interpret signals earliest and most accurately. The most powerful market moves are rarely announced. They unfold through behavior, policy shifts, and institutional positioning that appear unremarkable until viewed in hindsight. The hook many overlook is this. By the time a trend becomes obvious, the advantage is already transferred to those who prepared quietly while others waited for confirmation. Institutional actions function as leading indicators because they are driven by necessity rather than emotion. Governments, central banks, and large financial entities cannot afford reactive decision-making. Their scale demands anticipation. When these actors adjust exposure, secure resources, or alter policy frameworks, they are responding to structural pressures rather than short-term fluctuations. Individuals who learn to observe these signals gain insight into where risk is being reduced and where value is being protected long before prices reflect those choices. Preparation in economics is not about predicting exact outcomes. It is about positioning for ranges of possibility. Markets are complex systems influenced by feedback loops, incentives, and constraints that rarely move in straight lines. Those who wait for clarity often discover that clarity arrives only after costs rise. The hook here is that uncertainty is not a barrier to action. It is the reason preparation exists. Short-term noise, amplified by media cycles and speculative narratives, obscures these deeper signals. Price volatility, opinion-driven analysis, and emotional reactions distract from structural changes unfolding beneath the surface. Prepared participants focus on macroeconomic forces, supply dynamics, and institutional behavior rather than daily fluctuations. This discipline allows them to act with intention instead of urgency, reducing the risk of decision-making driven by fear or excitement. What separates preparation from reaction is time. Time allows for measured accumulation, risk management, and strategic patience. Reaction compresses decision-making into moments of stress. Where options are limited and costs are highest, economic transitions reward those who use periods of apparent calm to build resilience rather than complacency. The hook many miss is that preparation feels unnecessary right up until it becomes invaluable. Logistical disruptions and regional instability have exposed how quickly access to essential materials can be compromised. In response, governments are prioritizing redundancy, stockpiling, and domestic sourcing where possible. Concentration in specific mining regions and its dependence on byproduct production make it particularly susceptible to these disruptions, reinforcing its strategic value. This shift also reflects a broader redefinition of national security. Economic continuity, technological sovereignty, and industrial capacity are now treated as defense issues rather than purely market concerns. Resource control underpins all three. The hook many fail to recognize is that when governments secure materials like silver, they are not reacting to markets, they are insulating themselves from them. As competition for critical resources intensifies, those with foresight gain leverage. Control ensures stability during crisis, bargaining power during negotiation, and continuity during disruption. This is not about hoarding. It is about ensuring that national systems function regardless of external pressures. In economic terms, access to silver becomes a competitive advantage that compounds over time, reinforcing resilience while exposing the fragility of those who depend on open markets that may not always remain open. Economic history repeatedly demonstrates that markets do not reward those who react fastest to headlines, but those who interpret signals earliest and most accurately. The most powerful market moves are rarely announced. They unfold through behavior, policy shifts, and institutional positioning that appear unremarkable until viewed in hindsight. The hook many overlook is this. By the time a trend becomes obvious, the advantage is already transferred to those who prepared quietly while others waited for confirmation. In systems under strain, adaptability becomes the ultimate advantage. Those who prepare are not rigid in their expectations. They are flexible in their positioning. They understand that markets shift not when everyone agrees, but when pressures reach thresholds that can no longer be ignored. By studying signals instead of stories and structure instead of sentiment, prepared participants align themselves with change rather than chase it. In economics, this alignment is what turns uncertainty from a threat into an opportunity. So as we stand at this crossroads, remember this. Every major wealth transfer in history began with signals ignored by the majority and understood by the few. The question is not whether change is coming, change is already here. The real question is whether you will watch it happen or whether you will prepare yourself to move with it. In closing, understand this truth. Governments don't make billion-dollar moves without reason. When they secure assets, they are securing the future they see ahead. Your responsibility is not to copy their actions blindly, but to learn from their intentions, stay informed, stay disciplined, think beyond today's headlines. Because in a world where systems are shifting, the prepared don't panic, they prosper. And